All right, so you made the leap. You set up an S corporation. That's a fantastic move. You're probably already thinking about those great tax benefits. But here's the deal. An S corp is kind of like a high-performance engine. To keep it running sweet and avoid a super costly breakdown, you've got to know how to maintain it. So today, we are popping the hood. Think of it this way. Your S-Corp is like a luxury sports car. It's designed for amazing performance, and it can help you fly past a lot of tax hurdles. But that complex engine, well, it has a very specific maintenance schedule. So the real question for you is, are you the kind of owner who actually knows what's going on under the hood? Or are you just crossing your fingers and hoping for the best every time you turn the key? So let's get our hands dirty, shall we? We're going to break down your S-Corp's financial engine into 3 critical systems. And I mean it, if you can master these 3 areas, you're not just dodging trouble. You're actually fine-tuning this machine for a smooth and really profitable ride. Okay, first things first, let's start with the heart of the whole engine, the system that powers everything, and that's your people. This is all about compensation, payroll, and your team. And for an S-Corp, this is where the rules get super, super specific. If you get this part wrong, the whole engine can just seize up. Let's be absolutely crystal clear on this, because you can bet the IRS is. This is the #1, don't even think about it, non-negotiable rule of running an S-Corp. If you are an officer and you're doing work for your company, you are an employee, period. That means you must be on the payroll. So what on earth is reasonable compensation? Well, think of it like this. What would you have to pay a stranger to come in and do your exact job? That's the number. The IRS is a huge stickler for this because your salary, the money you get through payroll, is subject to payroll taxes. But distributions, the other way you can take money out, are not. You see the temptation, right? Some owners try to pay themselves a tiny little salary and take all the rest as distributions to dodge those taxes. And that is a massive red flag for the IRS. And that brings us right into a classic and potentially very, very expensive mistake: misclassifying the people who work for you. Is that person helping you out an employee, or are they an independent contractor? The difference is absolutely critical, so let's break it down. The distinction here is pretty black and white. A W-2 employee is on your payroll, you withhold their taxes. A 1099 contractor, on the other hand, is basically their own business. They handle their own taxes. But I want you to look at that last line. That's the key. That's the whole ballgame for you as the owner. You cannot, under any circumstances, be a 1099 contractor to your own S-Corp. You must be a W-2 employee. Now, to keep this first system running like a top, you have to get into a rhythm. It's a cycle, right? You run payroll regularly. You make your tax deposits on time. You file those quarterly forms, and then you do your annual forms. If you can nail this rhythm, you've mastered the first and honestly one of the trickiest parts of S-Corp compliance. All right, engine system 1 is humming along nicely. So let's move on to system number 2. This is all about the fuel for your engine. We're talking about the money that moves between you personally and the business. Okay, next up is a concept that sounds kind of technical and scary, but I promise you it's not. It's called shareholder basis. All this is really is a running tally of your total investment in the company. Think of it as your financial skin in the game. And why does it matter so much? Because this number is the gatekeeper. It's what determines if the distributions you take from the company are actually tax-free. The easiest way to picture your basis is like a water level in a bucket. When the company makes a profit or when you put your own cash into the business, the water level rises. When you take money out as a distribution, or if the company has a loss, the water level drops. Your job is to keep a close eye on this water level because, as you're about to see, you never ever want it to drop too low. And here it is. This is exactly why it's so critical. If you take a distribution that's more than your basis, if you take out more water than is in the bucket, that extra amount can suddenly become taxable income to you. If you're not tracking your basis, you're just flying blind, and you could be setting yourself up for a really nasty surprise come tax time. Now, here's a little pro tip for keeping this whole money flow super clean. It's called an accountable plan. This is just the formal, IRS-approved way for the company to pay you back for business expenses that you paid for out of your own pocket and to do it tax-free. The process is dead simple. You incur the expense, you submit your proof, and the company pays you back the exact amount. It is the best way to avoid mixing up personal and business funds. So we've covered power and we've covered fuel. The final system of our engine is the maintenance schedule. This is all about managing your company's long-term property and, maybe even more importantly, staying on top of that non-negotiable calendar of compliance deadlines. Let's talk about the big stuff, fixed assets. We're talking about the long-term investments in your business, your computers, your equipment, your company car. Now, because these things provide value for more than just 1 year, you can't deduct the full cost right away. Instead, the IRS makes you spread that cost out over the asset's useful life. And that whole process, that's called depreciation. Properly tracking these assets just means keeping a detailed list. What is it? When did you buy it? And what did it cost? This is the list you'll use to calculate that depreciation every year. Oh, and here's a crucial little detail. You can depreciate a building, sure, but the land that building sits on, that is never, ever depreciable. And finally, here it is, the maintenance schedule itself. These are the hard deadlines you absolutely cannot miss. January 31st for your W-2s, March 15th for your main S-Corp's tax return, and all those quarterly filings in between. My best advice? Put these in your calendar right now with multiple reminders. The penalties for being late are automatic and they are painful. Okay, we have covered the power, the fuel, and the maintenance schedule. I get it. It sounds like a lot of detail. So, what's the payoff for all this careful work? Why does it matter so much? Let's talk about that. Well, the first and maybe most obvious benefit is super simple. You stop throwing money away on dumb penalties. Late filing fees, late payment penalties, interest, it can add up so fast. Good bookkeeping is your #1 defense. Second, accuracy is everything. See, your S-Corp itself doesn't actually pay income tax. Instead, the profits and losses pass through to you, the owner. And this happens on a little form called a Schedule K-1. So if the numbers on your business books are wrong, the K-1 will be wrong, which means your personal tax return will be wrong too. It's a domino effect you do not want to start. And you know, the ultimate payoff might just be this: peace of mind. The feeling of knowing that your books are clean, they're organized, and they're defensible. That lets you run your business with confidence, ready for anything that might come your way. When it's all said and done, it comes down to this. High-quality books aren't just a defensive move. They're an offensive tool that makes sure you claim every single deduction you are entitled to and that you report all your income perfectly. It is the absolute foundation of a healthy business. So, as we close the hood here, I want you to take an honest look at your own S-Corp. You chose this high-performance vehicle for a reason, but the real question is, now that you know what a proper tune-up really involves, is your engine truly ready for the road ahead?